Hey everyone, welcome back to Corporate Decoder. Today we're diving into a Form 8K filing from FiscalNote Holdings. And let me tell you, this one's a bit like a roller coaster with extra fees and a surprise twist at the end. You think you know where you're going, but the fine print might just send you for a loop. In short, FiscalNote is making changes to some old debt they took on when they merged with another company back in 2022. They're basically kicking the can down the road and adding some interesting clauses that could either be a genius move or a ticking time bomb. Let's unpack it all. Alright, the main event here is that FiscalNote has made a deal with some investors called the legacy investors. These investors hold some old debt, which are basically loans, that FiscalNote took on when they merged with another company a couple of years ago. These loans are called legacy notes. As of late March of 2025, there was about $10.20 about $10.94 million still owed on these legacy notes. These legacy notes were originally due in July of 2025, but FiscalNote has worked out a deal to push that date back to April 2026. That's the first major change here. They bought themselves more time to pay off this debt. Now, here's where things get interesting. FiscalNote now has the option to convert some of this debt into shares of their Class A common stock. Basically, instead of paying back the debt in cash, they can give the investors shares of the company. There's a limit to how much debt they can convert, and the investors will only be able to sell the converted debt once the previously issued shares have all been sold. But the plot thickens. If the legacy investors don't make enough money from selling those shares to cover the original amount owed, plus interest and fees, FiscalNote might have to either pay them more cash or issue even more shares. It's a bit like a guaranteed return clause, but instead of cash, it could be more stock. And if the legacy investors still haven't made enough money by the original deadline that has passed, the interest rate on the debt jumps way up, from 15% to 25%, plus the amount still owed could potentially double. Ouch! That's a pretty big incentive to make sure those shares get sold. It's important to remember that the point of this is to make FiscalNote able to pay off what they owe. If things get that far, FiscalNote would have to pay the legacy investors the new doubled amount with the extra interest by the extended deadline with either cash or even more shares. This time they're called extended maturity date shares. Here's a clause that's a bit unusual. If FiscalNote gets bought out or has some kind of major change within a year after the legacy notes are paid off, the legacy investors get a piece of the action. They either get to participate in whatever deal happens or receive the same payment they would have gotten if they still held the debt. It's like they're saying, hey, even if we get paid back, we want a cut of the upside if something big happens soon after. There's a bit of an out for the company here. If the legacy investors sell all the conversion shares and or additional shares and get enough money to cover what they were owed, the legacy investors forfeit the remaining shares and don't get any other payments. This section just refers back to the information in item 1.01, basically saying that this new agreement creates a financial obligation for FiscalNote. Nothing new here. Again, this section just points back to the main agreement, confirming that any shares issued as part of this deal won't be registered with the SEC. They're using an exemption that allows them to do this without going through the full registration process. So what's the big picture here? FiscalNote is essentially trying to manage its debt load by pushing out the payment date and giving itself the option to pay with stock instead of cash. It's a risky move because if the stock price doesn't perform well, they could end up owing even more money or diluting their existing shareholders with more shares. Now let's step back and take a broader look at FiscalNote. On the one hand, they're showing some financial flexibility by renegotiating their debt and finding ways to manage their cash flow. This suggests they are working hard to reduce debt. On the other hand, the terms of this agreement are pretty complex and could backfire if the stock price doesn't cooperate. One of the biggest risks here is dilution. If FiscalNote has to issue a lot of shares to cover this debt, it could decrease the value of existing shareholders' holdings. Also, the increased interest rate if they miss the original deadline could put a strain on their finances. Overall, this move feels like a bit of a gamble. It could pay off if FiscalNote's stock price increases, allowing them to pay off the debt with shares at a favourable price. But if things don't go as planned, it could end up costing them a lot more in the long run. It all comes down to execution and how well they can manage their stock price and cash flow over the next year. Thanks for watching. If you found this breakdown helpful, please like, comment and subscribe for more deep dives into the world of corporate filings. Until next time.